On today's show, 3 questions. Number 1, are we ever going to see another recession? Number 2, are you investing or gambling? And number 3, what's the lifetime cost of a dog?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Taylor, and where's Robbie?
I can't say, yeah, you are. No, Robbie. We miss Robbie. Robbie had a medical procedure, nothing alarming, nothing super crazy serious, but he did have some medical things he had to take care of today, and so he is not going to be with us, unfortunately.
He was supposed to do a meeting with a client and and he was like, oh, I've got this medical procedure. So I told the client, I said, hey, sorry, we got to reschedule. Robbie's got to manage his life better and be healthier. So, that's what he's doing.
Yeah. Well, we probably should have teased that Robbie was going to join the show later, because the problem is people are going to hear that Robbie's not on and they're turning it off right now. That's the issue. People only tune in to hear Robbie, which I do not blame them. I only come on the show to listen to Robbie and get his wisdom. So Taylor and I are going to try to hold up the show today. And I'm a little bit sleepy, Taylor, because as you know, my son came up this morning before 6 a.m. and was sick, coughing, crying, having a hard time breathing. So I'm pretty sleepy. I was right in the peak, just perfect cycle of my, the perfect part of my sleep cycle. And I was jolted awake by my crying son. So
yeah. Well, I'm sure a lot of people can relate to that, Matt, because it is back to school season.
First week of school, of course he's sick.
So it's first week of school, kids get sick. My kids, knock on wood, right, have not gotten sick, but the crying and the emotions I can relate to.
I'm glad it's not just me. Holy cow, yesterday
a lot.
Yeah, it is a lot. It is a lot. Yeah, I got yelled at from my daughter the other day because she was really emotional and freaking out at me. And I said, hey, are you just a little hungry? Do we need to get you a snack? And she yelled at me, Dad, you always just think I'm hungry when I'm crying. And I was like, well, I think maybe you are. But she did not like that. So you think I'd learn better how to handle the little woman, but I'm still learning.
I've got an older woman I'm married to and 2 little women that are in my house. And I don't know if I'll ever get used to it, but back to school week comes with a lot of emotions and a lot of crying and a lot of change.
It's so true. Yes, it does. And I'm just waiting for that one. My daughter, she's only 7, but waiting for her to be a teenager, because the amount of eye rolling I already get as a 7-year-old, I'm like, oh boy, I'm in trouble when she's 13. So I already annoy her every day.
Yeah.
But with that said, let's jump in. So are we ever going to see another recession? We alluded to this was it last week or a couple weeks ago. And then friend of the show, not really, he doesn't know who we are, but we love his work, Ben Carlson. He actually wrote about this recently and brought up some really cool data. He did the work for me because actually I wanted to double down on this discussion and go gather the data. And then Ben did it for us. So appreciate Ben. So I'll just kind of set this up. Someone wrote into him, and I'll read what they said, and then we'll kind of expand on it. But so the person who wrote into him said, on various shows, the idea of the current economy being recession-proof or Teflon has come up. In the age of information availability and the ability to act on it instantaneously, maybe a full-blown stock market crash is not possible, short of massive black swan event like the first nuclear war. What if we're going? That's a little heavy. What if going forward there will only be sector pullbacks with the ability to rotate immediately and keep money in the market instead of just selling into cash keeps the overall market heading up and to the right. This is only enhanced by the transition from an older generation, hide cash under the mattress, to a younger generation, which is the FOMO, desire to get rich quick thoughts. So I wanted to read that because I think, and Taylor, I know you've got thoughts on this from things that you're hearing. I think this has kind of started to become, and maybe this is signs of the top, but this has started to become, I think, a little bit of the discussion kind of out there. I kind of call it like the Uber driver test. Like if Uber drivers start talking about are we ever going to see a market? That's the initial, that's going to be the top. But I think just the general discussion and feeling is kind of man, things are really good and have been really good for a long time. What are you hearing, Taylor?
Well, it's funny you brought this up because it actually ties into my topic that we're going to talk about here in a little bit. But literally yesterday, I jumped on with a guy, and this guy, he's got the Midas touch. I mean, everything he touches turns to gold, and he's successful at it.
Give him a handshake.
He's bought and sold several practices. He's dabbled in countless investments, right? And he's just always like moving and has deals going on. And what happened is he had this practice building that has been a great investment for him. It's from one of his first practices that he bought. It's in a different state than he is currently. But the guy that he's had a 10-year lease with is like, hey, I want to buy this place, right? Like, I don't want to lease anymore. I want to buy this. If not, I'm going to go somewhere else. So basically, he's being forced into buying this thing. He's going to have a windfall of several $100,000 in cash. And his first question was, is there anything I can do to limit my taxes? Right. That's first question. So we went through all the options, didn't like any of those. Right. And then his next questions were like, hey, what are your thoughts on the market?
Yeah.
Right. And I was kind of like,
what's going on here?
What are you asking me here?
Yeah.
And he's like, I know you're going to say you don't have a crystal ball and you don't know the future, but give me your real thoughts on the market. Like, what do you think? Right. And really what he was trying to get to was, is there something around the corner? Should I sit on this in cash? He literally said, what gets you excited? Is it a 10% drop? Is it a 20% drop? What correction should I be waiting for? What should I be looking for? That was his, like, ultimately, as I asked more and more questions, that was his question.
Yeah.
Right. And I think a lot of people have that underlying sentiment because it's like, this is too good to be true. Right. Mm-hmm. We've had too many good years. Something's around the corner. When is it? Tell me when. Right.
Yeah. Yeah. My favorite emails, which I've had so many over the years, always start with, I'm not trying to time the market, but but I'm going to proceed to explain how I want you to tell me how to time the market. It's just like, if they do this throat clearing or this caveat of like, no offense, but I'm going to say something offensive. It's like, I'm not trying to time the market, but I really am. And again, I get it. I totally understand. It's not like you're crazy of having that, but no, it really is not crazy. Like we've done this for a long time. This is our work, but it doesn't mean that we're not human and that we don't have the same feelings around like, man, I should have seen that coming, or starting to believe you can time this, or this idea of like, man, it has been really good. We're now 4th year in a row, double-digit returns on the S&P, and then we're kind of in this environment. We've talked about this before over the last few months. That just everything outside of Bitcoin, I don't want to emphasize that, but everything outside of Bitcoin is absolutely crushing everything. And so I do think there comes this.
Bitcoin had its best week in a long time.
Oh, there you go.
Matt,
yeah.
Didn't you see? That was on the front page today.
Should be careful. Dude, at some point I'm going to get jumped by the Bitcoiners. I know it. I'm literally going to get beat up.
This was the top story today on Yahoo Finance. Bitcoin nears best week in years. Here's what's fueling the rally.
Oh, it did. It shot up.
You just spoke this into existence.
I really did. I'm looking at it. It's like literally straight up. Still down double digits for the year. But yeah, you're right. It has bounced back a little bit. Anyway, so I totally get that sentiment or that feeling. And this is what we've said many times. This is why it never feels like a good time to invest, ever. Because we are always kind of negative tilted in our mind, and the media doesn't help with this, that either things are really bad, like we're in a negative cycle or recession, whatever, and people are like, oh, I got to wait till it comes back. Or we're where we are now, which is the sentiment is, it's too good to be true. This is going to fall at some point.
It's too good to be true, and I need to wait for when it gets bad to then invest.
To get in. Exactly.
And then when it's bad, it's like, well, I need to wait for it to get better to invest.
Yeah, so exactly.
It's the never-ending cycle.
So we are kind of foreshadowing and these are kind of going to blend together, but I wanted to share some interesting data here that Ben shared. This is right from the National Bureau of Economic Research. And what he did is he took the last 150 years of data in 20-year increments. And first he did recessions. So then he did bear markets. So those are two different things. In fact, I have this. I'm going to give you the definition of recession directly from the National Bureau of Economic Research, because it is a bit of a misnomer, misunderstanding, or mischaracterization that people define, like the classic definition of a recession is two straight quarters of negative GDP. But that's actually not correct according to the National Bureau of Economic Research. They define a recession as a significant decline in economic activity that is spread across the economy and lasts more than a few months. So a little bit of a broader definition from the government or from the National Bureau of Economic Research, not as specific as like we need to see two negative quarters. So there's a recession and then there's the bear market. Bear market being 20% or more drawdown. So since, again, 150 years, so he did them in 20-year increments. So from 1877 to 1896, we saw 5 recessions during that 20-year period. And the average length in months was 28.6. So pretty rough.
Yeah.
From 1897 to 1916, we saw 6, and the average length in months was about just under 20. From 1917 to 1936, we saw 5 recessions, 19 months average length. From 1937 to 1956, we saw 4 recessions, 10.5 months. 1957 to 1976, we saw 4, average length of 11 months. 77 to 96, 3, and it was average length of 10. From 97 to 2016, we saw 2, average length of 13. Here's the kicker, Taylor. So far, from 2017 to 2026, we've only seen 1 true recession.
We only got one more. We only got one more.
We only got one more left.
10 years.
And the average length in months was 2. So we've seen a rapid decline in the number of recessions per, and again, we're going off of shorter data because we only, from 2017 to 2026. But you see a steep decline, and the magnitude of those recessions has really dropped as well in the length. If we look at bear markets, number of bear markets, same time period, 1877 to 1896, 2, average drawdown was 45% in those. From 1897 to 1916, 3, average drawdown of 32%. We saw from 1917 to 36, 6, average drawdown 42. From 37 to 56, we saw 6 more, average drawdown of 32%. From 57 to 76, we saw 5, average drawdown 31%. From 77 to 96, we saw 3, average drawdown of negative 27. And then 97 to 2016, we saw 3 more, average drawdown of 42%. And then in the last 10 years, we've actually seen 3 bear markets, average drawdown of 26.
Yeah, but I mean, the context behind those 3 bear markets were they were the fastest recovering bear markets in stock market history.
Yep.
So that's why the recession that we had was so short. It was 2 months.
Totally.
And because these bear markets happened and then quickly recovered.
Yep. And I think it's important to highlight here. So if you look at this data comparatively, the recessions are stark from what we're seeing at the economic level. We're seeing 5, 6, 5, 4, 4, and then we're seeing them, all the way down to 2 and 1 over the last 30 years. We've only seen 3 true recessions over 30 years. And the length of time has been shorter and shorter. But that's different than than a market drawdown or a bear market. So just since 2009, the drawdowns we've had this is the S&P specifically. So since 2009, in 2010, we had a negative 16% drawdown. 2011, a negative 19%. 2018, negative 20%. 2020, 34%. Fast recovery, obviously. 2022, negative 25. People forget 2022 like it never happened. And then 2025, negative 19%. I think I want to highlight that because, yes, we're seeing more stability and far fewer recessions when it comes to the economy, but the market's been about the same as far as the ups and downs and the volatility for the most part. Yes, we're seeing much faster recoveries, no question. But we highlighted this a few weeks ago. People are like, we have to be due for a bear market or a drawdown of 20%. Like we haven't seen it forever. It's like, no. We did see it last year.
We just had one in 2025. Yeah.
We saw it last year.
I just had a conversation with a new client of mine, and he was, discussing some things, and we were going over his returns. And he was like, in the last 2 years, he averaged like a 17% annualized return, and he had $100,000 of tax loss harvesting.
Yeah.
Right. And it's
because of last year.
Yeah. You can't draw better market conditions than great returns and opportunities to tax loss harvest along the way.
Yep.
Right.
Totally agree. And again, I think we forget about 2022 quickly when we realize, or when we think back, that was a negative double-digit return. the end of the year. And Robbie said this a few weeks ago, based on what we're seeing, it's not crazy to think that we could see this bull market continue for another few years. He's not calling his shot there, but I think people lose track. I think in our mind, we think 2008, 2009 was the last bad market we had because it was so memorable and so like infamous. But it's like, no, we've actually had some pretty, again, shorter blips, but 2022 was the last bear market. To say we have a 7-8 year run post that, I don't think it's that crazy. So
no, and I think this is the most important thing here is we don't know.
Yeah.
Right.
Yes. As much as Jake and I like to predict things on this show. Yeah.
But like, this is the thing that the crux of everything that everyone asks us, like they really, when they ask us this question, they want us to give us some insight about like, is it a good time or is it not a good time? What do you think? And the answer is always, we don't know, because it could be that we're going to have a 2022 in 2026. Like it's entirely possible we're up, but it's entirely possible by the end of this year, we could have a double-digit down year.
Totally.
You know, something could happen, some crisis. We don't know, right? The whole point about the future, the whole point and the reason why markets drop is because they're unforeseen events. If we knew they were coming, the market wouldn't drop, right? So all of this stuff is we don't know. But to your point here, Matt, we can't just sit around and be like, well, I'm going to get a bunch of cash from this practice building sell. Should I just wait until that bad thing's coming?
Yeah.
Because the inverse is true, where it could happen, or it could be years before it happens, right? And you sitting on the sideline just means you missed on another 3, 4, 5 year run of a bull market.
Totally.
Because you were waiting for some event that may not happen.
Yeah.
Right.
It's so true. And people, it's understandable. We only think of risk when it comes to investing in the terms of what we can see on a screen, meaning volatility. We only think of that. So to your point, Taylor, of this client of yours, and we hear this all the time of, I'm coming into this cash or maybe not a big windfall, but just my excess cash. Should I be waiting? Because we're thinking of only one side of the coin there of, well, what if I put it in and we see a drawdown finally? That's a true risk. But the other risk is what you're highlighting here, that is kind of the invisible risk, but just as or more so damaging to your wealth, which is opportunity costs of you sitting on the sidelines. And if we think about it, like the only real risk that matters on the spreadsheet is permanent loss of capital. That's it. So even in that sense, volatility is not the true risk to worry about. It's my wealth losing value permanently over time. So for example, putting all of your money in some hot stock, every single dime you have, and that company going under, that's a true loss of capital. But true loss of capital also happens if you sit on the sideline for too long. I saw this post 2009 in my career at Fidelity countless times, 2013, 2014, 2015. I'm talking to people that are like, oh, I'm waiting for things to just feel comfortable again. And they're sitting in cash. And I'm like, you just missed out from a 2009, possibly once in a generation drawdown. And then what happened afterwards since then has been one of the greatest bull markets ever. And that person is in far worse position than somebody who put their windfall of cash at the beginning of 2022, saw the big drawdown and then rode it out till today. Like very different things. So I want to just highlight the different risks there.
Yeah. And it's scary for us as advisors, because I'll tell you firsthand, like I started bringing on my first like client as a financial advisor here at Dentist Advisor in October of 21. Right. And from October 21, then I had a bunch of clients come on board in 2022 and so on. And so the last down year was 2022. Right. But most of my clients were coming on board during that time. Right. And so since that time, every time we meet together at the end of the year, I have nothing but amazing news to give them. Right.
Yes.
And
like at some point, this is going to change.
It's so hard because all I do is like say, I know this is good, but just wait.
Yep.
I know this is good, but, right?
Yep.
I'm giving them the but every time.
Yep.
And so I've kind of ingrained this into my clients, like to my own insecurities of like, there are bad years coming.
Yep.
I feel like I'm kind of conditioning them to think that like, oh, I need to be waiting. And I think I need to do a better job as an advisor to be like, hey, this isn't good or bad. It's just what happened, right? Let's keep going, right?
Totally.
Because I just know in my head that there is going to be some down years. And so I'm trying to like preface clients to give them proper expectation that it's okay. And down years are actually good if you're a young investor and all the things. But you also need to be careful with the messaging of like, it doesn't matter good or bad.
Yep.
Just invest.
Yep.
Just invest. Just invest.
Totally. And that's a great way to bring this full circle and then go into, and we have melded these first two topics together, but full circle on this is, the question was, are we ever going to see another recession, or are we ever going to see another recession and or bear market? The answer is unequivocally yes.
And I think it's, are we going to see another prolonged recession?
Sure.
Right.
Yeah.
Are we going to see something significant that we have 20 months where we have this thing down?
The answer to that is probably yes. Now, again, we need to separate the two things. Recession and bear market are two different things, because the underlying economy and the stock market are not the same thing, although very intertwined, but they're not the same thing. So there is realistic data there. There is clear-cut data that recessions have become less frequent and less impactful and shorter duration, over the last 150 years. There's no shock as to why that's the case. The economy's completely changed over the 150 years, completely different economy now, as far as the type of work that we're doing, the information, and then more than anything, it's policymakers. It's how we actually approach these things through regulation and the government. So yes, even with that said, we will see another recession for sure. But even more of a sure thing is we will absolutely see multiple bear markets. If you're in your 30s, 40s, 50s, even 60s, you will see multiple bear markets by the time your career's over and by the time your life's over. You just better bank on that, because this is how investing works. You don't get the gains without paying the price of some pain. That's just not possible. So that is the whole game. And then human nature, humans are investing in the market. We're always going to have recession. So I'm the same way with you, Taylor. Whenever I'm doing reviews with my clients, I'm always letting them know, hey, we are in harvest years. This is awesome. We're seeing what's happening. This is amazing. You got to pay the price over time, and we're going to see some down years. Just buckle up for that. Be ready for that. Because you get a little insecure when we have 4 amazing years in a row.
Yep. Especially when I've been saying, average is 8 to 10%. And it's what are you talking about? You keep getting me 15. I'm what?
Yep. Totally. We earn our money in the years like COVID, or the years that, 2022 or the down years. So, okay, well, we kind of intertwine this, but Taylor, let's jump into, are you investing or gambling? Anything else you want to expand on this topic that we didn't hit already?
Well, I love that you, again, independently of me saying anything, brought up this recession thing, because this conversation yesterday with my client really spurned this. And so we're not going to use names, but this guy's first name is Mike. And so Mike, if you're listening, you can reach out to me. Occasional. I doubt he's listening, because it's Friday and but we'll see. He'll reach out to me if not.
Yeah.
But Mike, like I said, if he puts his mind on something, he can make money on it. But the problem is he is kind of a gambler, right? He likes to dabble in a lot of stuff, right? I had a conversation with him after I first brought him on board, and he was like, I think I lost $200,000 dealing in Japanese yen futures last year.
Oh my gosh.
And I was like, what? And he was explaining, and he was really deep into the weeds in some Reddit board, and was doing this. He did some crumble cookie franchises. He has done his fair share of real estate. He just brought up, a bunch of properties. Should I move this money into a bunch of residential properties in Alabama that are really cheap, and they pay $1,000 a month, and it just seems like free money. He is constantly looking for the next thing, the next shiny object. He really falls prey. And it's sometimes I just have to shake him and be like, Mike, if you just focus on your core business, you crush every time.
Yeah.
Right.
I know, but it's boring.
It's 100%. That's what it is. He loves the story, loves the next thing. He just gets bored by being really successful.
And does he know this? Does he admit this about himself?
He does, and he's willing to admit it, but he's also he wants to scratch that itch, right? And he and his wife, it's so funny when we get on calls together, because she's frustrated by the whole thing, right? And the whole reason why we're working together is Taylor, you are my you're my line in the sand. You're my North Star. You're the pole in the ground.
Yeah.
We're doing these, what he would call safe investments with you.
Yeah.
So that if all else fails, we're still okay.
Yeah.
And then I get to play with my other funds.
Yeah.
Right. So we have
$200,000 in Japanese yen futures.
So we have our savings, we have our automated savings that we're doing and everything. But, the conversation always gets away from us because he has all of these ideas and these harebrained things he wants to do. And I hope some of them work out.
Yeah.
Right. But the conversation he got down to was like, okay, Taylor, like I've got this money. It's worked out with you so far. I know I probably should put it on the market, but how can I do it in a way that it's still juicing my return or doing better, like allowing me to do that next thing, right? That next gamble, if we want to call it. And he was like, Taylor, what do you do? He's like, what gets you, like when you have that extra cash, is it 15%? Is it like what percent in the market should I be waiting for on this?
I know what you do.
And
you go on vacation.
It's literally what I told him. I said, I literally never have extra cash. And he was like, wait, what do you mean? And I was like, anytime I get extra cash, I take a trip. I have a really hard time. I think for the first time in years, I just hit 3 months in my emergency fund. And that's like a big deal for me because I just don't sit on cash.
Yeah.
Right. And that's not to say that I'm not investing and doing the things, but everything I have is 100% completely automated.
Yeah.
If I get a large windfall, it's completely automated so that the percentage that I want to save comes out of that. Right. And so everything is on automatic. There's no thought process. There's no trying to time the market. I never do anything. And he was like, and I think sometimes this is a common thing that people believe that we as financial advisors are holding something back or we're not telling them something.
Yeah.
But I am here to tell you, if you're listening to this, I am the most plain vanilla person you'll ever meet. My drink of choice is milk. Like I don't dabble in real estate. I don't dabble in real estate. Like I put the money in the market. I don't think about it. I let it run its course.
Yep.
Right. I have lived vicariously through hundreds of people doing these other things that I get enough. I get to like watch them gamble with their money. Right. But I do not do it. I'm not trying to. Right. And I think it's very common that people think this is what market investing is that it is more like gambling. Just today, I had a discovery call with a brand new client that just signed up. And they literally said, like, I know there's like safe, diversified things, but I just feel like the reason why I've hired you guys is I feel like there's probably some stocks and some aggressive takes that I can do inside my portfolio that I'm just not doing.
And you're like, right, boy, I have to let this guy down.
In my head, I'm like, yes, this is, I hope you're not too disappointed because that's not what I'm going to be telling you.
Yeah.
Right. But this is not, I don't blame consumer. I don't blame clients. No. I don't blame dentists. I think this is just, we're set up to fail in certain ways by the system. Right. So I wanted to first off make a comparison and say that LeBron James is the Warren Buffett of the NBA. So if you don't know, LeBron James is a famous basketball player, and so much media and content is around 5 words that LeBron says. If LeBron says anything, it's a headline, there's news. I do not know how the NBA is going to survive after he's gone, right?
So honestly, though.
And that is kind of Warren Buffett in the finance world, right? If Warren Buffett says anything, you can turn it into an article and get millions of reads, right? And Warren Buffett is getting up there in age. I don't know what's going to happen after Warren Buffett's gone. Yeah. Who are we going to quote? Who are we going to look to? Who's going to be our next North Star? Someone's going to have to come replace Warren Buffett.
Maybe it's 2 cents. Who knows?
Maybe it's Robbie.
It's probably Robbie.
It's Robbie. Maybe Robbie is taking over the Warren Buffett role.
Yeah, probably
I think our listenership, we get numbers. We're pretty close, right?
Oh, yeah. Yeah. I mean, we are the number one financial planning podcast for dentists in the whole world. So, I mean, I think we're the only one, but still, I think we are one of one. We're killing it.
The reason why I bring this up is I was, when I was thinking of 2 cents in this topic, there was the classic Warren Buffett's 10-word warning to investors.
Oh, boy.
Right? And so someone asked him a question and he said a response and it was 10 words. And so now they're making an article that literally is on the front page of Yahoo Finance. Yeah. Right. So again, if Warren Buffett says anything, it could be news. But he was quoted, someone was talking to him, right? And he said, it's tough to find value when everybody is preferring gambling. Right. And essentially the reason why this came up is I don't want to misquote this and be incorrect what I'm saying here, but Berkshire Hathaway for the last 14 consecutive quarters have sold more shares than they've bought. right? So for the last 14 quarters, which is not a short time,
Yeah.
right? They have been sellers more than buyers, right? And in the second quarter of 2026, that changed. They finally bought more than they sold, right? So it was like, hey, Buffett's been sitting on a lot of cash. Why now? And his whole thing was not like, what he was trying to say is like, I don't know better than anyone else. I didn't move to a bunch in cash because I knew better. His whole thing was like, I just had hesitations looking at these companies because a lot of these companies are what he would qualify as gambling.
Yeah.
Right. And as we know, Warren Buffett is more of a value investor. Right. And so it's hard for him to buy companies when he sees a lot of high stocks without the actual underlying metrics driving, actual profits with the companies themselves. Right. But we're seeing that gambling word a lot come up. Right. So Warren Buffett was specifically referring to companies themselves behaving like gamblers. Right. Matt, you just told me a thing. I'm sure you're going to bring it up here, but as a whole, gambling across the country is way up, right? Jake wrote a really good article this last week talking about sports betting and compared to investing. And just sharing a couple quick points from this. There was one study they did that just said, hey, how many people view sports betting as a long-term strategy in their finances, right? And if you look at boomers, it's like 1%. Next 6%. Millennials, 14%, right? Pretty higher than I would have thought.
Significant.
Like, that's not a small portion, right? Of people saying, I view sports gambling as a long-term strategy in my finances.
Yeah.
And for Gen Z, it's all the way up to 26%.
That is wild.
1 in 4 people saying, yeah, gambling is part of my long-term strategy.
Unbelievable.
Right. And then they had another one that talked about how many people have directed investing funds, money that they normally would put towards savings investing, towards gambling over the last year.
Yep.
And again, boomers, 4%, Gen X, 10, millennials, 31%.
Yep.
So a third of millennials taking money that they otherwise would have saved, being like, let's dabble.
We ever going to see another bear market? You just answered yes. That's why. Honestly, new generation of investors treating it like gambling.
Gen Z, 52%.
Yep.
Half of them have taken money that they otherwise would have saved and put it in gambling, right? Which we're trying to answer questions we probably can't have answers to, but I wonder if people are like, well, the stock market's so safe, in air quotes now, let's do other things to get risk involved in our portfolios. And I don't think like that's their actual strategy in their head, but I think subconsciously that's kind of what's happening.
Yeah. I think it totally is. And again, when I hear that, it's so clear as to why the answer is so easily yes to, are we ever going to see the bear market? Because again, that comes back to mindset, human nature, our approach, our emotions. And when you see what's happening with the gambling now, that permeates everything. And we're going to see it infiltrate things like investing. So yeah, I think it's a great point, Taylor, and a great reminder to emphasize to people that we talk about all the time, which is you got to understand what game you're playing. You got to frame, when you ask a question, a client or a dentist out there is thinking about anything in this realm, it always comes back to what game are we playing? There's stark differences between the kind of ego-driven gambling approach and the fundamental principle-based trying to build wealth over time investing approach. Those are two very, very different things. And I think people know that when they're in a calm setting and you're explaining it, oh yeah, that seems obvious. But the question is, are you actually acting like that in the actual actions and use around your money?
Yeah. Well, and it's crazy, again, where I don't blame consumers, I don't blame investors, I don't blame dentists. It's just kind of like human nature, right? Yeah. If things are created to be more of like a dopamine hit, then you're going to want to hit that every single day.
Yep.
Right. And you're going to think, if I put time and energy to this, I will do better. Right. Robinhood was not created to interface like a slot machine by accident.
Yep.
Right. Robinhood was deliberately created to feel like a betting app more than an investing app.
Totally.
Right. But it's crazy if you actually look at, they did a study just to kind of bring another one that I saw here with gambling and investing. They did a study of 18 to 20-year-old men who reported saying that they feel like a failure. And then they looked at their daily activities, right? And it is shocking. Like, I'm not going to make you guess because I don't want to make people feel bad, but like, there's probably certain things you would think of, like activities that men do on a daily basis that you'd be like, that probably leads. So again, video gaming's not bad by any way, shape, or form, but people who daily do video games said 47% of people who play video games daily report to feeling like a failure, right? Not good or bad. That's just a number, right? Guess what fantasy sports was?
Oh no. Don't tell me. I don't want to know. You're going to make me feel bad.
Lower.
Higher.
61%.
Whew.
Now, again, that's daily. It's not like people who do this less than daily, the numbers are far less. But these are people who every day are getting on there checking this, right? Getting that little hit. 61%, right? What about daily stock trading?
Ooh, interesting. Higher or lower than fantasy, you're saying? I'm going to guess higher because you're probably going in sequential order.
You've got it. You figured it out. 64%.
Dang.
Daily stock trading. And then the worst thing, gambling, betting, right? At 66%.
Yeah, it's probably because you are failing at that activity. Like, you're taking a lot of losses. That's what most people do.
Yeah. So, but that's the crazy thing about this is like, if you're doing something daily, if that's how you're investing, if that's how you're looking, if you're constantly checking your portfolios, if you're constantly checking your sports app, if you're constantly checking all these things, guess what? Studies show it's probably not good for you, right? Let alone for your returns, but it's also just not good for you emotionally.
Yeah.
Like 18 to 29-year-olds, 66% of people who are doing this on the daily admit to feeling like a failure.
Dang. Yeah. I mean, that's eye-opening. That's eye-opening. And yet, sadly, it won't stop. I feel like it's, it's only the beginning.
I think, the hope is that if anyone's out there listening to him and they are falling into some of these patterns, like the whole point is like, are you investing or are you gambling? Right. If your investing tendencies feel a little bit more like you're gambling, a little bit more like you are looking at this every day, you're checking different stock prices, you're doing all these things, you might want to check yourself, right? You might want to create better systems and better things in your life to help you feel better. And because at the end of the day, I feel like I'm stealing from Jake here again, like life's pretty great on the whole. Like life's never been better collectively as a society, but there's a disconnect with what's actually happening and how people feel.
Totally.
Right.
So true. And I think, to your point, hopefully bringing awareness to stuff like this can get people to kind of be like, oh, take a step back, zoom out a little bit, check what game I'm playing here. Am I a really key here, really easy is just like, am I seeking excitement or looking for like my identity in these activities? Like, for example, in investing or in gambling in this case, that's a really key indicator there, because kind of an old principle here that's stood the test of time, which is investing is not exciting. Gambling is exciting or can be. Investing should not be exciting. And so if you're seeking that excitement in your portfolio, I'd start trying to look elsewhere. So
we have a quote that we use with our clients on our first investment call, and it's investing should be more like watching paint dry or watching grass grow.
Yep.
If you want excitement, take $800 and go to Vegas.
Yeah, totally.
Right? Which is really outdated because you wouldn't get very far with $800.
Probably not. Are you kidding me? I was just in Vegas. Those table minimums, you're not going to get very far with that nowadays. But like, you want excitement, go ride a roller coaster. Go bungee jump, go jump out of a plane.
Go
or something.
Garden in your backyard, right, man?
God. Taylor, I just got the pictures from the landscaper, got all the final yard cleanup, prepped, ready to plant. I am going to be going crazy this weekend with the planting.
Or maybe buy a puppy or two.
Yeah.
Right?
Okay. Speaking of, thank you for the pivot. Stark transition here. We'll finish up with what's the lifetime cost of a dog. So we did this a few years ago, but it's become more pertinent. This is just selfish, Taylor. I'm not going to lie. This is my personal therapy session because I was talked into, I already have a dog. Shout out Wally, a 1.5-year-old golden retriever. He's the best. And what's better than one golden retriever, Taylor? Apparently two golden retrievers. So I was talked into last weekend. I was talked into getting another golden retriever puppy. And so now we have two. His name is Cub. He is also the best. We are very happy about him. They're already best friends and it's awesome, which was the whole point. But it got me thinking, bringing back this topic. I just think it's kind of fun around what's the lifetime cost of a dog. And it's actually pretty hard to find this, Taylor. There's a lot of like varying data. So I'll start with the high end. Forbes, I think probably went way overboard on this, but Forbes initially said, this a couple of years ago, said they estimate the lifetime cost of a dog to be anywhere from just over $17,000 a year to up to $93,000 a year, depending on size, breed, service requirement. First of all, that range is insane.
Where is that coming from?
Yeah, so exactly. Great question. So I was able to do some digging and I found the American Kennel Club. They got a little bit more specific here. So they kind of gathered data and were able to kind of normalize it. So this is where they came in. So small dog, small breed, average life expectancy of 15 years. They estimated $15,000. Medium-sized dog, life expectancy of 13 years, 15,782. And then average life expectancy of a large breed, they expected about just under $15,000. So where's the money going? So
going? That is blowing my mind, man.
Yeah.
You've just completely talked me out of ever having a dog right there.
Yes. So that, again, and this is saying, lifetime cost of a dog. Okay. So I just wanted to make sure
I thought you said it was 90,000.
Well, this is what's confusing. Forbes I'm reading this. They estimate the lifetime cost of a dog to be anywhere from 17. This must be a typo. This must be a typo. They're saying a lifetime cost of a dog to be anywhere from $17,650 a year to a staggering $93,000. They said
That's got to be lifetime.
That's confusing because they say a lifetime cost of a dog. There's no way. This is lifetime. We're just going with that.
Okay.
Let me do a quick.
Makes me feel better.
Hang on. Lifetime cost of a dog. We're going to do a quick one here. Just double check these numbers. Yeah. So our Google AI, they're saying somewhere between 15,000 to 50,000 is that range. Okay. A national average around 28,000 to 30 for a 10 to 15 year lifespan. Okay. So there you go. So we're on the same page. Now, where's the money going? So health. So routine visits once or twice a year, including wellness checkups. Well, that's perfect. I'm not going to take my dog to the vet ever, so I'll save some money. Kidding, dog lovers. Dental care costs. So $700 to $1,500 is what they're estimating. Doesn't include emergencies, medications, all that. Grooming. Grooming is another big one there. I have two. This actually was really sobering for me because I'm doubling now all of this. Food. They're projecting food anywhere from $120 a year to $900 per year. Toys and treats, they're projecting about $35 to $250 a year. Who spends the most on dogs, Taylor? So they broke this down by generation. Baby boomers, millennials have more pets than, let's see, this article is kind of hard to read. So 57% of millennial households own a pet, and the generation is 77% more likely than other generations to get a pet before they marry or have kids. So Taylor, you did the opposite.
We have a lot of them in our office that did that.
Yes, we do. We have quite a few. So millennials, the most. So 1/3 of millennials, which is the largest group of home buyers, buy a new home to have more space or better yard for their dog. So there you go. They also spend more on their dogs with purchases, pet care items, toys. So millennials are the ones leading this charge. Guilty. Here I am, guilty with 2 dogs. So did we talk you in or out of having a dog?
Well, just to put some context to these numbers, I was like, well, what's the lifetime cost of having a child?
Right. Boy.
So I remember back when I took the CFP, it was 250,000.
Yep.
Right. So that number has now gone up to around 310. Right. That's just what happens with inflation.
That's
right?
before there. That's to 18 though, right?
Before to 18. College. Yep.
So that's excluding college.
Yeah. So again, you're going right on the right track. True lifetime cost can range between 500,000 to 750,000. Right. And biggest thing there is, are you helping pay for college? Right. Yeah. Which a lot of our clients like to do. Right.
Yeah.
Now, again, they break this down. Your children are most expensive. When would you think that your children under 18 are most expensive?
I'd say high school, junior high school. It's got to be, right?
Yeah. So it's actually 0 to 5. Right.
Interesting.
And the reason is heavily daycare. Right. So
that makes
you
sense.
got to pay daycare. So it's usually 29,000 a year, 0 to 5. Cheapest time, 6 to 12. Right.
Perfect.
That's around 12,000. So you're getting there, Matt.
I'm right there.
And then the costs go back up to around 15,000 from 13 to 18. cost spikes mainly due to food consumption.
Exactly. Well, right? Here's one thing that they probably don't have in the data that we see anecdotally, and why I would say that junior high and specifically high school is the most expensive, because what we've seen time and time again is, and they're not counting this, I'm guessing, is vacations go way up. I hear this across the board. My siblings are in this stage of life. A lot of my clients are in this stage of life. Kids are getting ready to leave for college or go on their own, and vacations go way up.
Got to take the last trip, everyone together. Got to do that. I mean, I can't tell you how many people have taken last trips for the 5th time.
Yeah.
Their kids are leaving.
It's so true. My gosh. Yes. The once in a lifetime trip that happens twice a year.
Yeah.
Yeah. So true.
So, and I get it, you know, you want to have them, but then, and this is, again, middle income. If you're high income, this is only going to go higher.
Yeah.
Right. So it's sobering. You know, I tell my clients all the time, there's a spreadsheet answer and a right answer in life. Spreadsheet answer is not to have 4 children.
Yeah.
Right. So when you look at these numbers, you're like, man, am I giving up a lot? So the idea of having a dog on top of that, it's like, I've already got a lot of money.
Yeah.
It tied up in 4 of these kids. I don't know.
Yeah, you can get into like the spreadsheet zone of like, why did we do this? Believe me, I've had those moments. It's never with kids. Being a dad's just freaking awesome. So I hear those numbers. I'm like, yeah, it's worth it. Not even close.
Yeah, it just depends on the person and what you want. But I think the main point here is don't let the spreadsheet run your life. Right. If you want a dog and a dog brings you joy, they're worth every penny, right? We haven't gotten a dog because we have 4 kids, 8 and under, and that just sounds horrible.
Just lean into the chaos. Put it in the chaos tab.
Yeah, that's what they'll say. Lean into the chaos. And everyone says, you'll always want these years back. And I'm like, you can take these kids for a week anytime you want. And they never take me up on it, right? So I would like it to get a little less chaotic. But, you know, growing up and, you know, over the years having dogs, every time you lose a dog, it's like losing a member of your family.
Yeah.
Right. So you can't put numbers to this stuff.
Yeah.
Right.
Yeah.
There are numbers, but you can't, you know, live your life, do the things that make you happy. There's no competition to see who has the biggest net worth when they pass away.
Yeah. Yeah. Shout out Jake. We're just quoting Jake this whole time. But yeah, there's no award for being the richest person in the graveyard. Right. So, and it doesn't mean you got to spend it on kids, or you got to spend it on dogs, right? Just because someone else does that. It's, you know, choose your own adventure. But just, I like what you said, Taylor. We don't live in a spreadsheet. You know, it's fun to kind of look at this kind of stuff. Like, what's the cost? And yes, it is sobering sometimes to think about. But for me specifically, these dogs, my kids, the things that, you know, all those things are well worth the cost. Doesn't mean it is to someone else. So someone out there not having kids, great. No. Like that's totally.
No. These people I was talking to this morning, they, you know, kids, they're not interested in having any kids, and I'm telling them that spreadsheet would tell you not to. You know, like, I'm not here to talk you into it or out of it, but
totally,
they like to travel and they like to eat out, and spreadsheet does not tell you to eat out, right? You know, spreadsheet says go to Walmart and eat groceries, you know, rice and beans.
But I love Chipotle. I love Chipotle. So
you do. Yeah. I've never met anyone that likes Chipotle more than Matt.
It's my whole identity. Okay, there, Taylor. Well, anything else you want to add to the dog kid or investing discussion? Any other words of wisdom?
No, we just need Robbie back. Robbie,
we'll get Robbie back. He'll be back next week.
Get well soon. We'll see you next week.
If you're still listening, we appreciate you for hanging in, even though Robbie wasn't here. Most of you probably hit end on this the second you heard Robbie wasn't coming and you just turned on another podcast. But if you're still here, we really appreciate you. If you're out there listening, you need help with anything to do with your finances. If you're thinking, man, I need to break the cycle of gambling and I need help with investing or anything else we talk about and help with on the money front, we are here to help. You can go to dentistadvisors.com, book the free consultation button, click the book free consultation button, and we're happy to talk to you and help point you in the right direction. For now, Taylor, thanks for being here. Everyone, thanks for listening. That was our 2 cents. Till next time, have a good weekend. Take care.